Welcome back to the Student Loan Show. Today is Tuesday, April 14th, 2015. Tomorrow's tax day. Hope you got your taxes done or are setting aside a significant portion of this evening to get that done so that you can drop everything into the mail or click the button and e-file it on time. Of course, if you don't have the ability to file it on time for tomorrow, April 15th, then please make sure that you go ahead and you get that extension taken care of, which will get you out to October 15th. Buys you some time, buys you 6 months worth of time. I don't necessarily recommend it for you if you're going to owe money, but it's always better to get that extension as opposed to doing nothing at all. Never a good thing. But today what we're going to talk about is student loan default. Actually, we're going to talk only about federal student loan default. We'll talk about private student loan default next time, I think, but today we'll just talk about federal student loan default. And we're going to outline all the stuff that happens if you're in default, how to keep yourself out of default, and how to get out of default if you find yourself in it. Some do's and don'ts, helpful tips and tricks for you. And so let's just dive right into it, shall we? First of all, let's just establish what default is, because a lot of people don't know what default is. Default occurs when you're 270 days past due. Up until that point, you're just delinquent. I don't want to say just delinquent, but it's not default. You're in arrears. You've got a past due amount. So if you're 4 months past due, you've got a $200 a month student loan payment, then you're going to pay, in order to get yourself out of delinquency, you're going to pay the $800 4 months times $200 pop. You're going to pay your $800 plus your late fees, and you're good to go. You're all caught up. But once you go past 270 days, that's when stuff starts getting real. That's when you are no longer just delinquent. That's when you're actually in full-blown default. And when you're in default, there's a whole bunch of bad stuff that happens. First of all, you've got the bad credit issue. You're no longer listed as delinquent, which is negative as it is. You're in default, which is big time negative. Like on a scale of 1 to 10 for credit negative, delinquent is, say, a 4, and then default is, let's say, a 9. It's almost as bad as it's going to get. And that bad credit's going to continue for as long as you're in default. So if you're in default for a long time, then it's going to just follow you longer. So that's the first thing. The second bad thing that could possibly happen when you're in default is a wage garnishment. The government or the U.S. Department of Education can take 15% of your disposable pay each and every pay period to pay back the student loan, including, it's not just the principal, it's the principal and the interest, and it's also the collection costs. The collection costs can hover around the 20% mark of the balance due. So 15% of that disposable pay can be taken away from you. Let's talk about disposable pay, by the way. Disposable pay is not your gross before tax pay. It's also, interestingly enough, not your take-home pay. So you can't take your take-home pay, multiply it by 15%. No, disposable pay is somewhere in between. You take your gross and then you minus out the deduction of amounts required by law to be withheld. So in other words, you're talking about your gross minus your federal and state income taxes. You're talking about your FICA, which is your Social Security. You're talking essentially about just the deductions for your taxes and Social Security. It doesn't account for deductions for your 401k or your health insurance or your dental insurance or your life insurance or anything else. So instead of looking at your paycheck and how much money you've got coming home and then just take 15% off of it, you're actually going to lose more than 15% of your normal take-home pay. So your garnishment could be 15% of disposable pay. More than that, If you're married and you live in a community property state, and there are only some states that are community property states. California is one of them, which is one of the places where I practice law. But California is one of them. There are various community property states, and you probably know if you're in one of them, but you should definitely check, because if you're in a community property state, your spouse's income is also going to be subject to that 15% of disposable pay garnishment, unless you've got a prenup or some other legal mechanism for your incomes to be treated as separate. If not, they're community property. What's yours is mine, what's mine is yours, mine, and ours, and your spouse's income is going to be subject to that 15% of disposable pay garnishment. So on a household basis, you're going to wind out losing a significant chunk of change. So that's the first thing that can happen if you're in default on your federal student loans, or rather the second thing. We've talked about bad credit, we've talked about possible garnishment. In addition, you may be subject to a tax refund offset. The U.S. Department of Education can take your tax refund to pay back the unpaid balance of the student loans, including the collection costs. So that's a thing too. You're gonna lose not only your disposable pay, but you're also gonna lose that tax refund. And once it's gone, it's never coming back. You can't petition to get it back because you're unhappy, or even if you get yourself out of default later on. Once it's gone, it's gone. If you file taxes jointly, your spouse can file an innocent spouse claim depending upon your situation, and they may be able to get back their portion of the refund. But even if they can do that, that's still going to be still a bit of a headache. You still have to fill out additional forms. You still have to do stuff. You got to wait. You got to get the money back. And even then, it's only going to be your spouse's refund if they can file that innocent spouse claim. So if that happens, you want to sit down with your tax professional and ask the question about that. So that's the third bad thing that could happen. The fourth bad thing that can happen is you can't qualify for any new federal loans for yourself or for a dependent child if you're applying for a PLUS loan. So you're going to get nixed out for that. So if you've got student loans in default, you got federal student loans in default, you figure you want to go back to school, you want to apply for new federal student loans, can't do it so long as you're in default. Remember, so long as you're in default. If you're not in default or you get out of default, that's different, because then you'll be able to get new federal loans for yourself. But if you're in default, no go. If you apply for a PLUS loan for your child, no go. You're going to get denied out of that. And above and beyond all of that, the federal government can still sue you for the unpaid student loan. So, and that's going to happen more often than not if you're self-employed. That's typically where I've seen it. Because if the government's getting their money off of a garnishment and a tax refund offset, they're at least getting something. And the federal government doesn't really like to sue people. It's just an additional administrative step, takes more time, takes more energy. They prefer not to do it. But if you are self-employed and you don't get a refund, you don't have any disposable pay to garnish because there's no employer who's actually paying you, you're paying yourself, you can get sued. And if you get sued, then there's judgment, then there's additional notations on your credit report. You're probably going to want to hire a lawyer to be able to deal with the government to settle the case or mount a defense. So you've got those things to be concerned about as well. So if you're in default, you've got some pretty big things to worry about. You've got your bad credit. You've got a garnishment, which is going to make your financial life even more difficult. You're going to worry about a tax refund offset so that you're not even going to be getting back that money at the end of the year or at the beginning of the year that so many people depend upon for their finances on an annual basis. You can't get new federal student loans, and you may also be subject to a lawsuit. Lots and lots of bad stuff happens when you're in default. So how do we avoid default? Well, we avoid default And of course, if you're in default already, then hindsight's 2020, can't really do anything about it. But if you're not in default, the ways to avoid default: pay your student loans on time. Yeah, I know that's not necessarily easy when you think about it, but your federal student loans, look, if you can't make the 10-year standard repayment, you can look at a hardship deferment. You can look at forbearance. You can look at income-based repayment or pay-as-you-earn or extended repayments or extended graduated repayments. There are ways that you can recalculate or have your federal student loan payment recalculated to be able to help you stay on the side of the angels, to help you keep out of default and keep in the government's good graces, because as long as you're not in default, you can actually avoid all of the bad stuff that we talked about, right? So that's how you avoid default. Now, if you're in default, don't freak out. There may be some ways to get you out of default. There are three major ways to get out of default. The first one, and don't laugh, but the first one is you could pay off the balance in full. I told you not to laugh. I know you can't pay the balance off in full, but I have to tell you that it's a possibility. If you have the financial wherewithal, go ahead and do that. Pay the balance off in full. That's the first way. Second way is you may be able to consolidate those federal student loans. There are limitations. There are limitations on it, but you may be able to consolidate, which involves taking all your federal student loans, putting them together, and it's kind of like a refinance on a mortgage or a debt consolidation loan, but it's through the federal government. It's through the U.S. Department of Education. It's through their direct loan program. You can do that consolidation, and it'll scoop up all the loans, and it'll put you into a brand new loan. Also with the federal government, and there are limitations, but if you can do that, when you consolidate, it gets you out of default immediately. So if you're under a garnishment, or if you're about to file your tax return and you know you're going to get a refund, consolidation is going to take care of it immediately. Well, not immediately. It takes between 30, 60, sometimes even 90 days to get the consolidation finalized, but it'll get you taken care of, and that garnishment and that tax refund offset will immediately go away. And you'll be able to qualify for new federal loans. There won't be any lawsuit possibility, and that bad credit will stop because you won't be consistently reported as being in default month after month after month. So consolidation will help you, if you can do it, will help you immediately. There's also rehabilitation, which allows you to make interim payments to the debt collector, because when you're in default, you're only dealing with the debt collector. U.S. Department of Education won't deal with you directly. So you make interim payments to the debt collector. You've got to make 9 monthly payments to the debt collector. At the end of your rehabilitation, your loans go back into regular payment status. All of the bad credit from while you were in default goes away. It gets wiped out. You're no longer worried about a tax refund offset. You're no longer worried about a wage garnishment. You can apply for new federal student loans. There's no lawsuit possibility. All the bad stuff goes away. All of it just stops. Now, rehabilitation is going to take some time. It's going to take you 9 monthly payments. You know, if your rehabilitation payment is $50, you can't just send the debt collector $450 and say, well, 50 times 9, there's $450. We're done, right? No. You've got to make the monthly payments. And the reason for that is that the government and the debt collector both need to be able to see that you're capable of making these recurring payments, these monthly payments. Because if you're not, then you're just going to wind out being back in default again, and nobody wants that to happen. So you've got to make your monthly payments. So, and there are limits to that as well. You may not be able to rehab. Depends upon the loan, depends upon the loan history, depends on whether you've gone through rehab before. So you want to look into that. But those are the 3 major ways to get yourself out of default. Now, why do you want to get out of default? Well, this is simple logic, right? You get out of default, you stop your debt collection, you restore your credit, you stop your wage garnishment, you keep your tax refund, which again can be fairly considerable. You get to protect your property because nobody's gonna file a lawsuit against you for collection and be able to take a lien on your house or impound your car, freeze your bank accounts, none of that. And last but not least, you may be able to get your student loan interest deduction on your tax return. Some people don't realize it, but when you're paying your student loans voluntarily and on time, you're able to get a deduction up to certain limits and up to certain income limits, but you're able to get a deduction on your tax return for the interest that you pay every year. So you may actually get to save some money or get more money back if you're getting a refund. So there are some great reasons to get out of default. And last but not least, the federal government can chase you forever for your federal student loan debt. There's no limitation of time. So it's not like you can go past due on your federal student loans and eventually they'll just go away. They can follow you for your entire life. So if you get yourself out of default, the sooner you get yourself out of default, the sooner you can get things back on track. And again, even if it's not the 10-year repayment, if it's an income-based repayment or an extended graduated, there are ways to alter the payment amount due based upon your income that will allow you to actually live your life and keep yourself on the right side as far as the federal student loans are concerned. So if you're in default, you really owe it to yourself to sit down and either talk to an attorney, you can talk to me, you can talk to any other student loan attorney, or you can do it on your own, figure out a way to get yourself out of default. So that's the roadmap. That's it. That's the consequences of default on your federal student loans, how to avoid default, 3 ways to get out of default, and all of the reasons why getting out of default is so very important for your federal student loans. And of course, if you have any questions, you can email me. You can get in touch with me. Head on over to the website at studentloanshow.com. You can get in touch with me. I'm happy to answer any questions. I am available to let you pick my brain to sit down for a consultation or just ask me a one-off question and maybe we'll feature it on the show. If you like the show, by the way, head on over to iTunes and give us a review. I really do appreciate that. I read all of the reviews because it helps me figure out what's working and what isn't working and ways that I can provide a better show for you, give you more of the information that you need to be able to help get your student loans under control so that it's not so overwhelming and overpowering. And of course, if there's something that isn't working that you don't like, well, your comments are going to help me as well, because then I can stop doing the bad stuff and I can do more of the great stuff and give you more of a reason to stick around and listen every single week. So this has been Jay Fleischman for the Student Loan Show. You can check us out at studentloanshow.com, and I'll see you right back here next week.